In a moment, I'm going to hand over to Dr. Walter Boettcher, who is going to take us through the macroeconomic factors which he feels will impact UK retailing in the short and longer term. And then after that, I'm going to be talking to some of our guests about their perspectives from their respective parts of the sector.
There is a recovery in formation. Is it a V-shaped recovery? Well, it depends how you look at it. In monthly growth terms, the initial recovery has come and gone, as the V1 line in red on the chart aptly shows. However, the V2 line on the chart shows that the economy is still 8.5% smaller than it was at the end of 2019. Household disposable income may have fallen in Q2, but the household saving ratio is up from a normal 9% of disposable income in Q1 to a record-shattering 28% in Q2. This amounts to 100 billion in savings in Q2 alone. Given a normal savings rate, you'd expect around 30 billion in savings. This suggests there is a 70 billion amount in excess savings. I can promise you it was not interest rates that attracted the savings, but rather fear of economic unknowns. Given that the savings ratio is likely to remain elevated until an economic recovery is visible for all to see, this suggests that when recovery comes, there may be an awful lot of dry powder, certainly well in excess of 100 billion pounds.
What we've been doing is, I appealed to our landlords back in March, asking them to waive rent, particularly for when we weren't open or when our business was substantially down. And obviously, I think most of you will know that London has been probably the worst location. So we've had, I would say most of our landlords have been very sensible. We've worked well with them. They've waived a lot of our rents, and that's up to 9 months in some cases. And others, we've modified the basis on which we operate into turnover type bases including new leases.
And if you look at the legislation sort of changes that have been put in at the beginning, there's sort of 3 real changes that come through. They've got sort of so-called, this is under the Corporate Insolvency and Governance Act. We've got something called a moratorium, where the directors effectively are left in control, and they can get this moratorium to protect them from any actions being taken by creditors, but it has to be monitored by a monitor. Monitor, for people in my position, is quite an exposed role to take, and not one appointment has been made on that basis yet. There's also the sort of cram down plan, which they have as well, which only 2 companies have done that. That was Virgin Atlantic and Pizza Express. That hasn't really, well, only 2, quite complicated, quite expensive. But I think the expectation is that when the sort of moratoria cease and the government aid is withdrawn, then it is possible that those procedures will become sort of more possible or more popular, because they'll enable directors to take control of their businesses under certain sort of constraints and be more debtor in possession.
And in a way, the retail industry has actually been preparing for this moment and for the regeneration and restructuring since 2008 and the crash. And as I said, what we've seen is a real acceleration in the last 9 months. 5 years has been quite a long time in property, but the last 9 months seems to have flown by in terms of the activity that we've seen. And I think it's also worth bearing in mind and bringing some importance to the fact that we are coming to the end of what really is a 50-year cycle in the retail sector. It's a long time since the original bull ring opened in 1964. And for those of us that are just about old enough to remember, Brent Cross opened in the mid-1970s. And a lot of those schemes are now, and a lot of the changes that we saw in that sector, it's just a natural progression. It's not really a revolution, it's more of an evolution in our industry. And that's what we expect to see in the years to come.
Amazingly, I think our sector has once again showed its absolutely profound resilience. As David said, we've been in testing times for many years. This is a different and very big test, but a lot of the sector is proving itself to be amazingly resilient. And what that's meant is we do actually have an occupational market. It is skinnier, it's fragile, it's pretty slow moving, but it is there. but that still sounds very much like a market that we've had for the last few years anyway. So, you know, it's still there. And we touched on the video very briefly on, you know, you may have seen some of that slide come up with some of the logos of who's actively in the market. And there is quite a big group of occupiers who are planning for the short and medium term and see something in the UK market. I think they must have heard Walter's wall of cash analogy, and they want some of that for next year, I think. But you know, those retailers are a real mix of homegrown UK retailers, but there are also American, French, German, Scandinavian, Irish retailers all in the market right now to take new space in the UK.
We provided a 3-month rent-free for hundreds of our retail, leisure and hospitality occupiers, regardless of size, across the estate. And our kind of financial support continues to evolve, and we're offering very similar financial support for this kind of latest lockdown during November and December. And I think the key thing in doing that was we've recognised that we need to start to change the dialogue between landlord and tenant into much more of a kind of an open, positive conversation. In the majority of cases, you know, it's hugely time intensive, but in the majority of cases, we now have a much better understanding of our occupiers' businesses than we did before. And consequently, and again, you know, this kind of theme has come through through some of the speakers, you know, earlier, is that we're kind of trying to work much more in a partnership way to kind of find much better, more sustainable rental structures that benefit both sides. I think the other thing that was hugely successful from the government's perspective was the Eat Out to Help Out scheme, and we actually extended that at Grosvenor's cost for the month of September. And across the estate, that delivered roughly 50,000 people that used the scheme, an additional £1.5 million in additional turnover for the estate. And again, that was, you know, it's just a kind of real feel-good factor for everyone in terms of sort of getting out, really, you know, encouraging people back onto the estate, trying to encourage a level of normality that perhaps we, you know, we kind of hadn't seen before. And actually, you know, one thing that I think, you know, the country from the very top to the very bottom, it was that real kind of sense of just wanting to have a break, wanting to kind of have a great piece, you know, plate of pasta or whatever it might be, just kind of put in front of you and just not have to deal with the washing up that evening. And finally, you know, one of the areas that we're sort of looking at is we've recently announced an investment fund, you know, in recognition of the challenges that a lot of our occupiers are facing in terms of CapEx. You know, if they've taken out civils loans, the sort of the challenges that they face in terms of, you know, being able to borrow more money, whatever that might be. And we are wanting to use that fund to help kind of strategically mitigate and fill voids across our London estate.
I think that's the beauty of what we're doing. We're always able to tweak and evolve. And I think to Dan's point earlier as well, it's creating something that's flexible and a partner-led approach really with our occupiers. And we've certainly seen a very different group of occupiers that we're talking to and engaging with and transacting with versus, you know, what we would have been doing 2-3 years ago. But I think that's exciting, and I think it's an interesting part of the market.
And you have the Northern Line opening back end of next year, is it, the extension?
We do indeed. So that again will very much change how people are able to interact with Battersea Power Station and the surrounding area. We've got the new Zone 1 tube station, which will go live Q4 next year, and that will be an extension of the West End branch of the Northern Line. You know, it really just cements Battersea's place as a key part of London and the city.
There is a lot of really new and innovative brands and occupiers who are looking at the market and looking at London in particular and saying this is a truly global city. It's one of the best in the world. It will come back. We believe in its future. And here is a once in a decade opportunity to pick a building that we've wanted, that we've coveted, and it's now available, or it's an opportunity that can be available, and it's on rebased terms that make it economically viable. And you know, if you're optimistic and confident, those companies are saying, well, actually, I'm going to take advantage. And if there's light at the end of the tunnel, and we think we might have, you know, herd immunity through the vaccine by the summer of 21, and as Walter has suggested, cash in the attic being ready to spend, then you know, I'm actually very, very positive about the sort of medium term for London and it's returning to its former glory. the structural change that's been happening in the market has just been hugely accelerated, and I don't think there's any going back to the old way of doing it. It's a brave new world, and the winners are going to be those people that are ready to adapt and evolve. And I think, you know, we've heard it already today about the flexibility that owners and retailers are showing. And it, you know, in many days gone by, we used to talk about the landlord and tenant partnership, which never really existed. I think as a result of this crisis, I think it will going forward. There definitely will be a proper landlord and tenant partnership, and both sides, you know, can prosper together.
We mentioned that supermarkets and retail warehousing are kind of the two which we've seen the greatest momentum. Putting supermarkets, first of all, in context, we're obviously not at the year end yet, and Q4 is our busiest season. But we're currently, there's about £1.5 billion of supermarket investments have transacted this year. And to give you an idea of how that fits in the context of a general market, the 10-year average is about 1.3 billion. So we anticipate there's a fair amount of product under offer at the moment to close out in the next month or so, but it's looking likely that we're going to have another, obviously a very strong year in that supermarket world. It's probably the other kind of observation we're seeing is that if you add up the shopping centre volumes and retail warehousing volumes at the moment, it's only broadly about £100 million ahead of supermarket volumes at the moment. So really does show how that classic flight to safety, retailer stayed open, has done very well in this crisis, has understandably gone into a flight to safety from investors. The other thing I was going to say, though, which kind of slightly laughs in the face of all of this, is if you actually look at the volumes to date in those three particular areas, so excluding High Street, we're currently at just over about 3.2 billion has transacted. If you actually look back to last year, it was 3.6 billion. So it's probably not the huge change that we may have expected, but I would say you do need to take into consideration what we have seen is yields moving out. So vendors' expectations have certainly dropped. So where we've seen yields, certainly in retail warehousing, fall out a long way, we've got a new breed of investor coming in who is happy to commit to those products. So actually in volumes, they will be lower, there's no denying that, but we're still having a reasonable level of transactions.
There's absolutely no doubt that the pandemic is reframing the way that shoppers engage and use physical stores. And that's actually what has totally underpinned our ideas behind the new model. So any new leasing model, as I said in the video, has to be dynamic and it has to stay aligned with changes in consumer behaviour. One thing we can be sure of is that physical pure till-based sales will continue to have the highest proportion of the total transactional value of the store. But what's really important is that we start to build a model based on all channels that drive value for a store. And that's, as I say, that's the framework for the model. Again, another idea behind it is to benchmark physical retail stores against online in a way that's never been possible before. And that's thanks to the amount of data that we have access to today. One thing I just wanted to mention briefly is it is really important to mention the validation process that we've been through so far in terms of before we've gone out to press on this. It's really important to say that this has been through had input from valuation and investment experts, and then we've had a select group of landlords and occupiers, so on both sides of the fence, to get buy-in. At the moment, we're testing it on quite small scales at the moment to support further validation, and we're hopeful for a larger rollout next year.